2015 has been one of the worst years for oil and for metal prices. What are the drivers behind offer and demand? We're turning to Saad Rahim, who's chief economist for the Trafigura Group, for some explanations. Good afternoon.
Good afternoon.
Welcome to the studio.
Thank you.
Let's start with a bit of a macro overview because it does explain a lot of things.
I think when we look at the global economy, I think one of the things that stands out is really that China at the end of 2014 and the beginning half of 2015 really showed a very sharp slowdown. But what I think people don't quite realize is that the projections for 2016 are actually looking much better than 2015, in part because we are seeing some stabilization in China, but also that we are seeing good growth in the US and in Europe. I think where people are focused on right now is the fact that manufacturing is in recession. And so people really pay attention to that. Whereas the services part of the economy, which is in most economies the much larger part, is actually doing very well. So in the US, for example, services and consumption are about 85% of the economy, and manufacturing is only about 15%.
And that now also extends to China.
Exactly. And I think that's the other thing that a lot of people don't realize, is that they're still used to thinking of China in the old terms, and that they're very focused on the manufacturing and infrastructure development. But now, for the first time ever, services and consumption are a larger part of the economy in China, 51% versus the manufacturing and investment sector. So the shift has already taken place. And I think when we look at it, we are seeing really strong growth in, for example, the retail sales sector, which are now over $5 trillion.
Yeah, I was pretty amazed when you gave me this figure the other day, because you said it's larger than the Japan economy.
It's larger than the Japanese economy, it's larger than the German economy, and it's growing at 11% per year. So if you can only imagine that if the Japanese or German economy were growing at 11% per year, people would be delighted.
Yes.
But because it's the overall context of China, they're seeing it as a slowdown. And so I think that's maybe a little bit of a misreading. It is having an impact on commodity demand, because obviously consumption is a second order demand. It's not like infrastructure development where it goes directly into that consumption.
But still, I mean, you gave me some figures about car sales projection. I mean, I guess we'll see that perhaps later when we move on to metals, which is going to be a bit the core of what we want to talk about. But
absolutely, I think globally when we look at it, again, the consumer side of it, and by consumer, we extend that to both real estate and to vehicles and other big purchases, which do have a very direct impact on demand. Whether you're buying houses, which contain a lot of metal, cars, which contain a lot of metal, or you're then consuming in terms of electricity and energy and oil and gas. And so all these things do have an impact.
And there's a lot of stimulation coming from the government as well in China, even on infrastructure.
Absolutely. And I think they're not doing what they did in 2008 and 2009, which was simply to open up the stimulus taps, but they're trying very targeted programs to try and get certain sectors of the economy back on track. And you mentioned vehicle sales. So both in vehicle sales and in the real estate sector, they have changed the requirements in terms of down payment and financing. So that's really given these sectors a little bit of a jump start, and we're seeing that in the numbers now.
Okay, let's briefly get back to oil. I mean, it's the big topic. Everybody talks about oil.
Yes, they do.
Not that many people know what they talk about, but oil is an offer shock. I mean, there's too much oil being produced. How is this going to adjust?
I think that's right, is that really the key driver there has been the oversupply situation. Demand has actually been very strong. And again, not many people, I think, realize that 2015 in particular was one of the strongest demand years we've had for some time. So that isn't really the issue. It has been the growth of oil in places, in particular the US, which has led to an oversupply situation. Now, how does this rebalance? To me, look at the producers that got you this increase in the US. And if we look at the chart, we can see that a lot of this growth has been funded by debt, which is fine when the Fed had 0% rates. But now that they're raising rates, this starts to cause problems for some of these producers. So you would expect some of these producers to start to go offline, take some of that production off, and the supply and demand start to rebalance.
There's an interesting point you made the other day about productivity in the shale industry. It's increased enormously. What happened?
Well, I like to say that at $100, everyone was very happy, and they just sort of, did things however they wanted to. And at $30 oil, everyone suddenly discovered efficiencies and competitive advantage. And so they really went in and tried to get as much productivity as they could, whether it was focusing on higher grade areas, whether it was cutting costs, staff, negotiating with suppliers, so to really bring those costs down. And we saw that work for some time. In particular, last summer, we saw huge increases in productivity per rig, somewhat on the order of 10% in some areas. So that was able to offset the falling rig count overall. You had less rigs, but you had more production per rig, so it balanced. That now has come to an end. So now we are not seeing that type of growth anymore. So again, that's where we expect some of this supply rationalization to come in.
Now let's move on to metals, because metals it's also an offer problem. It's not only a demand problem, as many people have put it. So can you explain a little bit more and also differentiate for each metal, because they don't have all the same story?
No, absolutely. And I think you're right that unlike oil, where it was just a supply problem, in metals it is both a supply and demand problem. And on the supply side, it's a dual problem. One is globally you've had a lot of projects come online with the intention of feeding what seemed to be insatiable Chinese demand. And a lot of those projects have come on right at the time that we have seen this slowdown in China. The second part of that is that you've also had a lot of capacity within China. So China, for example, now is bringing in iron ore and exporting steel, whereas before it was assumed that they would just continue to consume the steel at home. So that shift in the flows has really had an impact on the metals market. Now, again, when we saw this slowdown in China, we saw a slowdown in the housing sector, but also in infrastructure development. What that meant was for certain key metals, in particular copper, which is used as a barometer of the global economy, really saw a slowdown. And yet now, again, we're starting to see some of these sectors turn around. So housing prices, for example, have started to turn back up. They haven't done so in the tier 3 cities, which is where a lot of the inventory overhang is. But in the tier 1, like Beijing, Shanghai, and tier 2 cities, we have seen these come back up. So we expect that to start picking up demand for metal over there. The other thing is, as we talked about earlier, is vehicle sales. So due to the new requirements, we've seen this jumpstart in the market, and sales on an annualized basis in December rose to about 34 million vehicles per year. Now, it's just 1 month, but that's 34 million versus 17 million in the US per year. So you can see the magnitude of the impact that that's having there. Now, as we said, in each of the metals, it is a little bit of a different situation. In 2015, metals moved as a class, as an asset class. So metals prices generally went up or down all together. And now in 2016, we are seeing a bit of a divergence. And where you still have overcapacity, we're seeing prices still remain a bit depressed. But in places where you have seen some supply cuts, like in zinc, or you are seeing demand start to pick up, like in copper, where the Chinese state electricity grid now is going to be increasing its spending by almost 30% over the next 5 years. And again, we've started to see that in some of the numbers. You're starting to see prices stabilize a bit more. In other areas, we're looking to future demand, so in things like aluminium, where increasingly you're seeing that being used in vehicles and in airplanes and other transportation, that demand is just starting to revive. But again, we expect that to start picking up very soon.
You made an interesting point about metals, is that the price of metals has dropped in dollars, but the dollar has risen as well.
Absolutely, yes.
And most of the producers do not produce in dollars, they produce, say, in ruble, like Norilsk for nickel. So they're not that affected, at least not as much as it would seem, by the drop in prices.
I agree, and that's been a big factor over the last year because the dollar did move so much. And as you say, local producers really reap that benefit in terms of their costs. And that has helped to flow back into metals prices overall and keep those at lower levels. But right now, the dollar has actually stabilized quite a bit against most of its trading partners because the big move was really in anticipation of the Fed. That first hike has happened, so now you've seen a bit of that stabilization. But I think where we get back to, and there's been this report from Macquarie, one of the leading commodity banks, on this very fact. And if we look at the chart, you can see that for most of these commodity areas, a lot of that production is still underwater, meaning it's not making its break-even costs. And so there still needs to be that supply rationalization.
Yes.
Some of it has been deferred because of things like currency effects, but it still is taking place.
Saad, thank you very much for joining us today.
My pleasure. Thank you very much.